Somewhere in the last 5 months, something happened that made every loan you might ever take out more expensive. Your mortgage, your credit card, a loan for your business if you have one. That thing has mostly resolved itself now. The prices never came back down. You're still paying for a crisis that, on paper, is basically over. So where did that money go? And who's collecting it? Start with the number that should bother you most. Whatever you're paying to borrow right now, it's higher than it was before this all started. Not slightly higher, meaningfully higher, in a way that shows up in a mortgage quote, in a credit card statement, in the interest line of a small business loan. And the thing that supposedly caused that increase has largely gone away. So why hasn't the price? Let's start with what's supposed to happen. There's a simple, almost mechanical relationship most people carry around in their heads about interest rates. The Federal Reserve moves its short-term rate, and everything downstream follows along. A few weeks later, a little quieter, a little smoother. Cut rates and credit cards get a bit cheaper. Cut rates and a small business loan gets easier to justify. Cut rates and eventually mortgages drift down too. It's not a perfect model. Nobody who studies this seriously would tell you it is. But it's the one most of us are working from, consciously or not, because it's simple enough to hold in your head while you're deciding whether to refinance or wait another year. And for a long stretch of last year, it mostly held up. The Fed cut 3 separate times. Borrowing costs eased, slowly but noticeably. People started planning around it. Businesses penciled in cheaper financing for the year ahead. Homebuyers watched mortgage rates and waited for the next leg down. Then came a shock. Early this year, a war broke out that threatened to choke off a huge share of the world's oil supply. A narrow shipping channel that a fifth of the planet's crude oil moves through suddenly became a war zone. Prices for everything tied to energy spiked hard and fast within days, not weeks. Inflation, which had been drifting gently back towards the Fed's target, jumped sharply instead. And bond investors, the people who actually set the price of long-term borrowing, whether they've ever thought about your mortgage or not, got spooked. Yields across the board moved up sharply, not just a little. The kind of move that shows up in headlines. The kind of move a mortgage broker calls you about, unprompted, because they know you'll want to lock in a rate before it gets worse. 2-year yields jumped. 10-year yields jumped. 30-year yields jumped hardest of all, eventually touching levels the market hadn't seen in almost 2 decades. Here's the part that should stop you. That crisis has largely faded. The acute phase of the conflict cooled. A ceasefire, imperfect and repeatedly tested, more or less held. Oil prices worked their way most of the way back down, retracing almost the entire spike, right back toward where they started before any of this began. If the story really were war causes fear, fear causes higher rates, then as the war eased, rates should have eased with it. That's the textbook. That's what almost everyone, including plenty of professional forecasters, expected. It didn't happen. Rates today sit meaningfully above where they were the day before that war started, not by a rounding error, by enough to change what a monthly mortgage payment looks like over the life of a loan, by enough to change whether a small business owner takes out that expansion loan this year or waits, again, for conditions to improve, by enough that if you're carrying a balance on a credit card, the math on paying it down just got quietly, permanently worse. So if the original excuse is gone, what's actually holding rates up? It turns out there isn't one answer. There are 2. And they're not the same problem wearing different clothes. They're genuinely separate mechanisms, hitting different kinds of debt for different reasons, moving on different timelines, controlled by different people. Understanding which one applies to you is the difference between waiting for relief that's actually coming and waiting for relief that isn't coming anytime soon. Let's take the first one. This one lives at the short end of the curve, the part of the bond market that shapes credit card interest rates, adjustable business lines of credit, anything tied closely to what the Fed is actually doing right now, this quarter, this meeting. And this year, the Fed got a new chair. His name is Kevin Warsh, and his very first meeting running the Federal Open Market Committee, changed the entire conversation, almost overnight. Coming into that meeting, most of the market expected a fairly boring outcome. Rates on hold, some cautious, hedged language about watching the data. Business as usual, the kind of meeting that barely moves markets at all. Instead, the committee's own internal projections flipped. Where members had previously leaned toward cutting rates before the end of the year, the median official now penciled in a hike instead. Close to half the committee explicitly wrote down that a rate increase might be appropriate before December. That's not a minor technical adjustment. That's the entire expected direction of policy reversing in a single afternoon in front of a market that had spent months positioning for the opposite outcome. The market noticed immediately and violently. The 2-year Treasury yield, the maturity most sensitive to what the Fed is likely to do in the near term, jumped by more than 15 basis points in a single day. To put that in context, traders described it as the sharpest single-day move on a Fed decision day in almost 2 decades, going back to the depths of the 2008 financial crisis. Stocks fell hard that afternoon too, more than 0.5% across the major indexes, as investors recalculated what higher for longer actually meant for everything from tech valuations to auto loans. And Warsh, in his first press conference in the job, didn't soften any of it. He declined to submit his own rate forecast, saying flatly that it wasn't helpful to policy. He kept his opening statement unusually short, and he said, plainly, without qualification, without the kind of hedge that usually follows a sentence like this, that the committee would deliver price stability. No, we'll see how the data comes in. No conditions permitting. Just a flat statement of intent from a man 3 weeks into the job. Why does any of that matter to your credit card bill? Because credit card rates, and a lot of business lending, aren't really priced off some abstract idea of the economy in general. They're priced fairly directly off what the Fed is expected to do in the next year or two, sometimes the next few months. Banks build in a margin, sure, but the base rate underneath your card's APR moves with expectations for Fed policy, not with the Fed's actual meeting-by-meeting decisions. When the expected path shifts from rates are heading down to rates might actually go up, the floor under short-term borrowing costs rises with it immediately, before a single policy meeting even happens. Your card issuer doesn't need the Fed to actually hike. The mere expectation is enough to keep your rate exactly where it is, or push it a little higher on the next billing cycle. That's villain number 1. A new Fed chair, a hawkish opening move, a market that took him completely at his word, and a chief economist at one research firm describing the reaction simply as, in her words, evidence that the wind had changed on the inflation picture. But here's where it gets more interesting, and where the story stops being simple. That same day, the day the 2-year yield spiked, the day stocks fell, the day headlines called it a hawkish shock, the 30-year yield, the one that shapes mortgages more than almost anything else, actually fell slightly. Not a typo. It moved in the opposite direction on the exact same day in reaction to the exact same meeting. Which tells you something important. Something that should reshape how you think about this whole problem. Whatever's keeping mortgage rates elevated, it isn't Kevin Warsh. It's something else entirely, sitting further out on the curve, moving to its own rhythm. And it's been building for far longer than his brief tenure in the job. This is villain number 2, and it has a name economists have used for decades: the term premium. It's the extra return investors demand to lock their money up for 10 years or 30 instead of rolling it over in shorter, safer increments. Think of it as the price of uncertainty over a long horizon, the compensation a lender wants for not knowing what the world looks like in year 25 of a 30-year commitment. For most of the period after the 2008 financial crisis, that premium was unusually low, sometimes close to zero, occasionally even negative. Investors were willing to hold long-term government debt for almost no extra compensation at all, in part because central banks around the world were actively buying huge quantities of it, soaking up supply and keeping prices high, yields low. That era is over. Economists Tobias Adrian and Richard Crump working out of the Federal Reserve Bank of New York, built the model that most of the market still uses to track this premium day to day. It's become something close to an industry standard, cited constantly by strategists trying to explain exactly this kind of divergence. Their work shows something that's easy to miss if you're only watching headlines about wars and Fed meetings. The term premium has been quietly climbing back for well over a year now, independent of any single news event, independent of any one Fed chair's tone in a press conference. It's not reacting to a war. Wars come and go. And this premium kept rising through periods when nothing dramatic was happening at all. It's reacting to something slower, less dramatic, and honestly less fun to make a video about. A growing pile of government debt that has to be sold to somebody year after year with no clear endpoint in sight and no politically easy plan to change that trajectory. And the numbers behind that are not small. The federal government's borrowing needs have jumped sharply in recent months in ways that show up directly in Treasury auction results. One recent estimate put net new borrowing for a single quarter at close to $190 billion, up from roughly $109 billion just months earlier, nearly an 80% jump in a single quarter's financing needs. Zoom out further, and the government is now borrowing on the order of $155 billion every single month of this fiscal year. That's not a war expense. It's not a temporary emergency line item that disappears once a ceasefire holds. It's the ordinary, recurring cost of running the country, and it keeps compounding on itself because a growing share of that borrowing now exists just to pay interest on the borrowing that came before it. The government is currently paying something on the order of $24 billion a week, every week, just in interest on debt already outstanding. That number has nothing to do with Iran and everything to do with math that started accumulating years ago. Researchers Anil Kashyap and Jeremy Stein, economists who've spent years studying what happens when the Treasury market comes under stress, going back to the disruptions of March 2020, have pointed out that this kind of sustained structural issuance pressure behaves very differently from a short-term shock. A war ends eventually, one way or another. A supply disruption resolves, ships start moving again, oil flows again. But a government that needs to sell ever larger quantities of debt, quarter after quarter after quarter, doesn't get a ceasefire. There's no negotiation that makes that number smaller next year. Investors know that, and they price it in accordingly by demanding a little more yield to hold the long end of the curve, persistently, whether or not anything dramatic is happening in the news that particular week. It shows up as a slow, grinding upward drift rather than a sharp spike, which is exactly why it's so easy to miss if you're only paying attention when something explosive happens. So now you have the full picture, both halves of it. Two separate mechanisms hitting two separate kinds of debt for two separate reasons on two separate timelines. If you're carrying a credit card balance or you run a business with a variable rate line of credit, the thing that matters most to you isn't the deficit, isn't the term premium, isn't any of the slow-moving structural stuff. It's what the Fed says next and how the market interprets the tone of a man who's made it very clear in his first few months on the job that he'd rather over-deliver on fighting inflation than risk under-delivering, the way some of his predecessors were accused of doing. Watch what he says at the next meeting. Watch how the committee's projections shift from one quarter to the next. Watch whether the language in the official statement gets even shorter or starts to soften. That's your weather system, and it can genuinely change fast, sometimes in a single afternoon, as you've already seen. If you're shopping for a mortgage or your business is trying to lock in a long-term fixed loan, the Fed chair matters far less than you'd instinctively think, even though he's the one who gets all the headlines. What matters more is whether the government's borrowing trajectory changes in any meaningful way, whether investors start demanding even more compensation for holding 30-year paper, or whether that term premium finally starts to ease as the fiscal conversation shifts, if it ever does. That's a slower, quieter, far less headline-driven story. It doesn't have a press conference. It doesn't have a single villain you can put a name and a face to. but it's arguably the more important one of the two, because it doesn't resolve itself just because a conflict ends somewhere in the world, and it doesn't reverse just because one Fed chair softens his tone at one meeting. There's a version of this that could sound cynical, like nobody's really in charge, like rates are just permanently stuck for reasons no single person controls or can be held accountable for. That's not quite right either, and it's worth being precise about that. Both of these forces can move, and move meaningfully. A dovish surprise from the Fed, a run of soft inflation data, a change in tone at a single press conference could bring short-term borrowing costs down fairly quickly, the way we've already seen them move up quickly. A credible plan to slow the growth of federal borrowing could ease the term premium over time, the way it's eased before in past decades when fiscal conditions genuinely improved. Neither of those things is impossible, neither is off the table, but neither is guaranteed either. And critically, neither one is waiting on the thing that started all of this 5 months ago. The war isn't the obstacle anymore. It never really was, not for the long end of the curve, and increasingly not for the short end either. That's the uncomfortable part, and also, if you sit with it, the genuinely useful part. The event that first pushed your rates higher has largely passed. The oil shock retraced, the acute panic faded. The excuse, the single clean explanation you could point to and say, that's why, is gone. What's left behind isn't a temporary spike waiting patiently to unwind on its own, the way a lot of people are still quietly hoping it will. It's two separate, ongoing, actively managed decisions made by two separate sets of people in two separate rooms that happen to land on your bill every single month, regardless of what's happening in the news. One of those rooms is a conference room at the Federal Reserve, where a new chair with something to prove is choosing his words with unusual care. The other is a Treasury auction most people will never watch, where investors are quietly, unglamorously deciding how much extra they want to be paid to trust a government with a growing borrowing habit and no obvious plan to shrink it. Neither room is thinking about your mortgage specifically. Both of them are setting its price anyway. Something happened 5 months ago that made every loan you might take out more expensive. It's mostly over now, at least the part you read about in the news. What's still sitting on top of your interest rate isn't a leftover shockwave from that event at all. It's two entirely different decisions made in two entirely different rooms, neither of which is finished making up its mind.